Welcome back to Dividend and Conquer, the place where smart investing meets practical advice. Today, we're diving into a question that sparks debates among investors. Is it better to invest a large sum at once or to invest smaller amounts periodically? Whether you've come into a windfall or you're planning to invest your hard-earned savings, this is a question you can't afford to ignore. Let's start by unraveling this financial conundrum. If you've ever wondered whether to invest your $10,000 bonus or to break it down into manageable bits, you're not alone. The answer isn't straightforward, as it intertwines with market trends, personal risk tolerance, and investment goals. Think of it like deciding between eating an entire chocolate cake in one sitting or savoring it slice by slice over a week. Sure, devouring the whole thing at once might seem like a sweet victory, but there's a good chance you'll end up with a financial tummy ache. On the other hand, slicing it up means you'll enjoy the taste for longer. But let's be honest, there's always the risk of someone else, read market volatility, sneaking into the fridge and nibbling away at your cake, investment returns. Now I know what you're thinking. But hey, what if that cake is the last one on the shelf and it's on sale? This is where market trends come in. Imagine the cake is a hot stock and its price is rising. Do you buy the whole cake now, hoping it'll be worth more tomorrow? Or buy it slice by slice, risking the price per slice going up? It's a a financial dilemma. Let's not forget about your personal risk tolerance. Are you the type to skydive without batting an eye, or does a trip to the dentist require a pep talk? If you're the former, maybe taking the investment plunge feels like just another Tuesday. But if you're the latter, the slow and steady approach might keep your heart rate in a healthier zone. And finally, your investment goals. Are you saving for a beach house in the Bahamas? Or are you just trying to make sure your retirement doesn't involve a part-time gig as a superhero mascot? Your end game plays a big role in how you slice your financial cake. So, whether you gobble up your investment opportunity like it's Black Friday, or nibble at it like a cautious squirrel, remember, the best strategy is the one that aligns with your goals and risk appetite. Before we dive deeper, if you're finding this discussion insightful, don't forget to hit that subscribe button. Join our community for more empowering investment strategies. Investing a lump sum means plunging your entire amount into the market at once. It's like taking the plunge into the cold water. Shocking, but exhilarating. On the flip side, periodic investing, often known as dollar cost averaging, DCA, is like slowly acclimatizing to the pool by dipping one toe at a time. It involves investing set amounts at regular intervals, regardless of market conditions. Historically, markets tend to rise over time. This trend favors the bold, those who invest a lump sum. But history isn't a crystal ball.
My crystal ball?
It looks like a snow globe.
Nah, it's real. Here, watch. Free Doritos at the office today?
It doesn't guarantee future outcomes. Now let's get into the nuts and bolts. Imagine two scenarios. In the first, you invest a lump sum of $10,000 in an index fund. In the second, you spread the same amount over 10 months. Which strategy comes out on top? This is where market timing plays a crucial role. If the market is on an upward trajectory, the lump sum investment might reap larger rewards as it exposes the entire amount to potential growth from the get-go. However, if the market dips shortly after your investment, the periodic approach could mitigate losses, as you're not fully exposed to the downturn. Remember, market timing is notoriously difficult, even for seasoned investors. That's where DCA shines. It's a disciplined approach that helps you avoid the emotional pitfalls of investing. It smooths out your purchase price over time, potentially reducing the impact of volatility. But here's a twist. Studies show that lump sum investing often outperforms DCA. Why? Because markets generally go up more often than they go down. By sitting on the sidelines, you might miss out on significant growth periods. However, the beauty of DCA lies in its psychological comfort. It's like having a safety net when you're learning to walk a tightrope. The idea is to invest consistently, regardless of the market's ups and downs. This method can be particularly appealing to those who might feel queasy at the sight of market dips. Think of it as a slow dance with the market, where you're less likely to step on any toes. Lump sum investing, on the other hand, is akin to jumping on a roller coaster. It's thrilling, but not for the faint-hearted. You're all in from the start, which can be great if you hop on at the right time. But if you miscalculate, well, let's just say it's not just the roller coaster that's going down. The key question is, how good are you at predicting market movements? If you're like most of us, predicting the market is as successful as trying to predict the weather in a city with 4 seasons in one day. That's where lump sum investing becomes a game of financial Russian roulette.
Let's play a little Russian roulette.
Sure, you might hit the jackpot, but there's also a chance you'll hear the ominous click of a market downturn. Now think about the stress factor. Investing a lump sum can be akin to watching a high-stakes sports game where your entire life savings is the star player. Every dip and rise can either send you leaping for joy or reaching for the antacids. DCA, however, feels more like watching a season-long series. There are ups and downs, but you know there's a long game in play. Another aspect to consider is opportunity cost. With DCA, your money waits on the bench, gradually entering the game. During this time, part of your investment might miss out on potential market gains. It's a bit like having a ticket to a hit show, but choosing to watch it in parts. You might miss some exciting scenes. Yet it's important to remember that both strategies have their place in the world of investing. It's not about which one is universally better, but which one aligns better with your unique financial situation, goals, and, importantly, your sleep quality at night. Whether you take the lump sum plunge or wade in with DCA, the most crucial factor is your comfort with the choice. It's about finding the balance between maximizing returns and maintaining peace of mind. After all, investing is not just about growing wealth. It's about doing so in a way that lets you enjoy the journey as well as the destination. Let's talk about another crucial factor: your emotional and financial readiness. Investing isn't just about numbers, it's about your comfort and peace of mind. If the thought of seeing your investment drop by 20% sends shivers down your spine, DCA might be your best bet. It's about sleeping well at night, knowing that you're growing your wealth at a pace that suits you. If you're a risk taker with a long-term view, lump sum investing could be your golden ticket. But if you prefer a more measured approach, DCA offers a less turbulent journey. Now, we're curious to hear from you. How do you prefer to invest all at once or bit by bit? Drop your thoughts in the comments below. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. And there you have it, folks, a deep dive into the world of investing strategies. Before you go, hit that like button and subscribe for more insightful content. Stay smart, stay informed, and let's conquer the world of dividends together.